use of derivatives and financial innovation exploded dramatically after 2000.
So help me God.
So help me God.
By the time George W. Bush took office in 2001, the U.S. financial sector was vastly more profitable, concentrated, and powerful than ever before. Dominating this industry were 5 investment banks, 2 financial conglomerates, 3 securities insurance companies, and 3 rating agencies. And linking them all together was the securitization food chain, a new system which connected trillions of dollars in mortgages and other loans with investors all over the world.
30 years ago, if you went to get a loan for a home, the person lending you the money expected you to pay him or her back. You got a loan from a lender who wanted you to pay him back. We've since developed securitization, whereby the people who make the loan are no longer at risk if there's a failure to repay.
In the old system, when a homeowner paid their mortgage every month, the money went to their local lender. And since mortgages took decades to repay, lenders were careful. In the new system, lenders sold the mortgages to investment banks. The investment banks combined thousands of mortgages and other loans, including car loans, student loans, and credit card debt, to create complex derivatives called collateralized debt obligations, or CDOs. The investment banks then sold the CDOs to investors. Now, when homeowners paid their mortgages, the money went to investors all over the world. The investment banks paid rating agencies to evaluate the CDOs, and many of them were given a AAA rating, which is the highest possible investment grade. This made CDOs popular with retirement funds, which could only purchase highly rated securities. This system was a ticking time bomb. Lenders didn't care anymore about whether a borrower could repay, so they started making riskier loans. The investment banks didn't care either. The more CDOs they sold, the higher their profits. And the rating agencies, which were paid by the investment banks, had no liability if their ratings of CDOs proved wrong.
You weren't going to be on the hook, and there weren't regulatory constraints. So it was a green light to just pump out more and more and more loans.
Between 2000 and 2003, the number of mortgage loans made each year nearly quadrupled.
Everybody in this securitization food chain from the very beginning until the end, they didn't care about the quality of the mortgage. They were caring about maximizing the volume and getting a fee out of it.
In the early 2000s, there was a huge increase in the riskiest loans, called subprime. But when thousands of subprime loans were combined to create CDOs, many of them still received AAA ratings.
Now, it would have been possible to create derivative products that don't have these risks, that carry the equivalent of deductibles, where there are limits on the risks that can be taken on and so forth. They didn't do that, did they?
They didn't do that, and in retrospect, they should have done.
So did these guys know that they were doing something dangerous?
I think they did.
All the incentives that the financial institutions offered to their mortgage brokers were based on selling the most profitable products, which were predatory loans.
If the banker makes more money if they put you in a subprime loan, that's where they're gonna put you.